Good evening, everyone, and welcome to Investing in a Slow Growing World. This is a joint webinar hosted by FP Markets and FN Arena, presented by Rudy Philippic van Dijk. Now, for those of you that don't know, FP Markets is an Australian-owned and ASIC-regulated broker located in Sydney and has been a leading performer in the industry for the past 12 years, receiving over 34 industry awards. We facilitate low-cost execution in Forex, direct market access CFDs, indices, commodities, futures, and more recently Bitcoin via our MT4 platform. Just to let you know, we will also be running 2 promotions off the back of this webinar. For our MT4 customers, you will receive a 20% trading bonus up to 2,000 Australian dollars relative to your initial deposit. And for our Iris CFD accounts, we'll be offering no minimum ticket fee for the first 3 months on the ASX. So for a trade with a market value of $1,000, you'd only be paying $1 in commission. And most importantly, with every new funded account, you'll receive a free 3-month subscription to FN Arena, which is valued at $165. Now, the link to apply and the terms and conditions can be found in the chat and will also be included in a follow-up email from your attendants. You may also email the sales team via email at sales@fpmarkets.com.au. Now, this offer is valid till the 1st of the 1st, 2018. Also, if you have any questions around the webinar, please hold them off to the end, or alternatively, you can send them through to sales@fpmarkets.com.au to be passed on to Rudy. Now, Rudy will give you a little bit more information around what FN Arena is and what they do, and he'll also begin the presentation. Thanks.
Good evening, guys. This is as you probably can hear from my voice. Now it's finally Rudy talking. I just have a glass of water with me, and I also have a few copies of my book with me, but that's not gonna inspire anyone because you can't see me, but luckily you can hear me. First thing that happened, by the way, first things first. The guys at FP Markets here, they are obviously delighted to for me to allocate some of my time here this time of the year, this time of the day. But I'm obviously very delighted that you are allocated some of your time while I'm here, and that's even better as far as I'm concerned. Now, when I came in, of course, the first question being asked is, Rudy, what do you think about what's the market going to do? So before, as a prelude to my presentation, I'm happy to share a little bit of my short-term views about the Australian share market. I think the best case scenario would be for nothing to happen with the tax plans in the US, because I have seen this year, and has been my view for quite a while, that as long as we have the prospect of tax cuts in the US, that is going to support the US market, and by default, therefore, keep support on the Australian share market. A little bit of a lesser scenario, in my view, is if there's a quick resolution in the tax plan over there, and then I believe we will probably get a sell effect. The worst case scenario, of course, is when we get a tax cut through, and then we get a delay, or when it actually kicks in, or it falls through the whole plan, and that's then we'll probably get a bigger sell-off, I think. Having said so, let's not spoil the party. That's short-term view of me. I think we are moving into a cautious zone here instead of a take a lot of risk on board zone. But we'll definitely talk about a little bit about more through the presentation, and I'm assuming I will get questions at the end as well about it. 3 years ago, and you should see that slide on your screen now, 3 years ago I published a book, which I'm aware that most people would not have read it, but I recently gave some presentations. I traveled to Adelaide. I saw a few people in Paddington in Sydney, and this is where this presentation sort of found its origin. 3 years ago, I published this book, which obviously is available, and definitely if you are an FNarena subscriber, you would have this and hopefully have read it. Not everything you predict in broad terms ahead is always comes to fruition exactly in that format, but there's definitely something in that book that came to fruition, and that's why I happily present you the following slide, and that's why it says on top it was 100 years ago today. And a lot of attention traditionally has been given to the fact that in the 30s we had this massive depression and two bear markets essentially, and the Federal Reserve making mistakes at the time, etc., etc. But what is not always emphasized is what preceded the 1930s, and that was the 1920s. And the 1920s, I hope you will all print that in your memory and in your conscience, is that the 1920s was an absolute fantastic time. It was a time when the world literally changed almost every day, and that was because a lot of inventions and innovations that had been made either in the 2 decades before that or in that particular decade, they all came to fruition, and they all found their way into modern, at that time, modern society. And you can just imagine if you are used in living in a house without electricity, that all of a sudden you will have electricity, you are connected to the grid. All of a sudden you have light bulbs, you have refrigerators, you have vacuum cleaners, you have radios and hair dryers, etc., etc. The cars were mass produced. We have everything from band-aids to earbuds. They all come from that period. Penicillin, etc., etc. So the world literally changed in front of your eyes if you were young enough and to be living in those days, and that of course translated into a massive boom into the share market. And for those who still remember the dot-com years just before 2000, you can only imagine what happened in the 1920s. Now, one of my predictions in my book, and one of the I think accurate predictions I make, is that we are probably going to go through a similar decade in the now, again in the 20s. So it's going to be 100 years ago. The main difference, however, is that 100 years ago, all those innovations, they created new industries and new jobs, and everyone was getting well paid from the new industries. The key difference here today is that all those new innovations we are about to experience, they're actually impacting on existing business models, and that obviously, of course, is a key difference. And that's why I believe the first phase will be a negative one in many respects, and over time it will become a positive one. At the moment, I believe we are on the negative one at first. Now, a little bit of a sidetrack. This is not very often highlighted, because most people who work and talk and write about finance, they always believe that you have to have a positive story to tell. Now, I'm a little bit different, because I think we can sometimes learn a lot from things that are not necessarily perceived as being that positive. One of the very rare events that has happened this year is that Australia, from the share market perspective, has just closed off a lost decade. And that's why I want to emphasize it. It's actually quite rare that this happens. Usually, and that's where a few of those often used myths come from, but usually, if you wait 10 years, your share price is higher than 10 years ago. The share market will be higher than 10 years ago. And this time it hasn't happened. And it's easy to reflect back on it, because just to go back to the year 2000, I mean, National Australia Bank was close to $40. BHP was above $40, and you know that those share prices, I just named those two, are well below where they were back then, and even including dividends, you would have a hard task in getting a good return from those starting points. Now, I believe that we can probably learn a few things from what happened there, and that's why it also figures in this presentation and also in my book, of course. If I mean, it's too much to share with you the whole lot here, but if you want to do some research in how the general context in the Australian share market has changed throughout this last decade, I suggest you start in 2002. 2012, I mean. Lost 10 years here, but I suggest you start in 2012, and that is also a very good starting point because it gives you a 5-year horizon. Because the reason here was very simple. Between 2007 and 2009, of course, we had the massive bear market. Then we had the recovery, the V-shaped recovery, which lasted until 2012-ish. And then we had a period which I believe characterizes very much the dynamics which we are to a certain extent still experiencing in the Australian share market. Now, I can talk about this for hours, but maybe you want to do some extra research in this as well, and you can easily do a 5-year horizon for a lot of stocks and see how they have performed in this new environment in the Australian share market. I'll give you a few secrets that are already in place over those 5 years. Banks underperform, small caps perform better than large caps, and the healthcare sector is absolutely killing it. And you can see that also on this chart. It actually has the sectors in the bottom part. It has the sectors and how they have performed over that period. And you see that the healthcare sectors absolutely killed it. And surprisingly, I'm sure that this will come to surprise to a lot of people. The IT sector is number 2. Now, a lot of people are going to say, but we don't have an IT sector in Australia. Now, that's absolutely wrong. 5 years ago, I would have backed up that view, and I would have said, like, yes, you're right. And the IT stocks, they usually put an IT here, like Computershare and Iress. They're not even IT stocks. But in the past few years, the Australian Stock Exchange is changing quite dramatically. And one of the things that is changing quite dramatically is that the Australian share market is more and more becoming the home ground for IT stocks. And you see that with the new IPOs and gradually the impact on indices in Australia also is becoming larger and larger. One of my absolute favorite stocks in Australia, regardless of whether it's IT or not, is Technology One. And you can see how that stock has performed over the past years, and only in recent times it's getting some attention. Of course, I mean it's now 150% higher than where it was, but there's much more happening than simply Technology One. In recent times, you will find a lot of those stocks like the WiseTech Globals and the Altiums are getting a lot of attention from investors, and there are very good reasons for that. These are high quality first class stocks that we have access to in the Australian share market. As a sidestep, never forget also that we have Cochlear and ResMed, which are again very high quality global leaders in their field, and they are technology stocks. It just happens to be that they operate in the healthcare sector, and that's why everyone puts a healthcare label on them. They are not the same as Ramsay Health Care and as CSL. And with those words, I'll leave that to you. This slide says it all. This is one of the conclusions I stated in my book 3 years ago, and this is one of the conclusions I like to emphasize when I do these presentations, and in particular when I look back at the past 10 years. We may not necessarily have caught up on this unless in recent times, but this message was already seeping through in the Australian share market over the past 4 or 5 years. The future has arrived, and it's not beneficial for all the stocks in the share market. It's beneficial to some though, and those investors who have paid attention to this, they should have done well to date. Now, I'm going to share with you now the way I see the Australian share market. Now, basically, have now decided that I divide the Australian share market in 3 baskets of stocks. The first basket, those are the stocks that are already being disrupted by new technologies and innovations. And if they're not already, they soon will be. And of course, we can all come up with the obvious sectors, the traditional media companies, the telecom sector, supermarkets. In recent times, we're all concentrating on the retail sector, in particular the bricks and mortar retails, but there are other sectors as well that are being impacted. I would nominate here as maybe not that much as a hot item at the moment, but it will be, is the wealth management industry. We will also see life insurers and maybe insurers in general, and we will see the providers of credit. And those sectors are already being impacted. And you will find, for example, a question which I get on a regular basis, because once upon a time I used to be quite positive about a stock like this, and the stock is FlexiCorp, for example. And people keep on asking me, like, why is FlexiCorp not performing better? It offers such a high yield and it's nothing wrong with the stock. And I disagree. I think FlexiCorp is being disrupted, and that means that its business model is now under a big question mark. And that's why the share price is not performing. And it's actually, if you take a 5-year view, a tear will probably jump out of your eye, because it is not a positive picture there. Now, moving on to the second basket of stocks, and I mean, no secrets here. I just talked about the 2 sectors that are definitely presented in this basket. These are the stocks in the share market that are not being affected by new technologies and innovations, and they might even benefit from it. And the obvious examples, of course, are the technology stocks and the healthcare stocks. And keep this in mind, because I'm going to get back to this, and I'm going to easily explain to you why these stocks have performed so well, even though they may not necessarily have seen an acceleration in growth. But I've mentioned a few stocks here on the slides for those who can read, and I'm assuming that's just about everyone. Some of my favorite stocks: CSL, Technology One, NextDC, Corporate Travel. Those are definitely names that I believe should be on everyone's radar, because those stocks have long, robust growth ahead of them. And temporary weakness in those share prices, I believe, should be used to scoop a few of them up and put them in your portfolio. Now, the third basket is the newcomers, and those are the new business models that are upcoming and listing on the ASX. And I've listed a few names, and you probably will know a few of them, because in particular this year, some of those share prices have gone parabolic. We're talking Afterpay, Touch, Xero, Zip Money, Kogan, Aconex, WiseTech, and obviously there's at least another dozen, if not more, of stocks that are in that basket. Now, while this all may sound very logical, I would like you to also take a view on those 3 baskets from a risk perspective. And if you take a view from a risk perspective, then all of a sudden a lot of things that happen in the market will become very, very clear to you. The first basket of stocks are stocks that used to be loved by everyone, but their risk profile has changed, and that's why they have derated. The second basket of stocks, they are the ones who are benefiting, remember, or are not being affected. So they have re-rated. Their valuation has increased over the past years. And from a risk perspective, that's very logical to happen, because the chance that they have to come up with a profit warning over the fact that they have to restructure or to review their business model are very low. And that's why you deserve a higher valuation. The third basket, that's of course the basket of a lot of excitement. But as we all know, not all excitement ultimately leads to a sustainable growth business model. So I've listed here a few companies which I believe have a higher chance of proving to be survivalists, is that if I can use that word, instead of just a flash in the pan. And that third basket, as we all know, will have a few flash in the pans, although that may not necessarily be obvious in such a short-term period. Just remember that in share market terms, 1 year is very short. Often bad news or good news takes longer to materialize. My apologies. I'm going to have a sip to the water as well, because from all this talking you get a little bit of a dry mouth every once in a while. Here I would like to take a step back from the share market just for a few minutes, and I'm trying to explain to you here the impacts of what is happening on all of us and of the institutions in society. And in a very simplistic format, society has four pillars. We have the government, we have the consumers, we have businesses, and we have labor at the very bottom. And of course, I mean, there is a very tight connection between consumers and labor. And usually that sort of works together. I mean, if one gets too bossy over the other one, there's often correction and that sort of works. In recent times, that has stopped working. And the reason for that is because the new technologies and innovations are now benefiting businesses and consumers. For businesses, they can see their margins increase, their costs lower, and they can produce so much more and offer so much more. For consumers, they can get access to so many more services and to products at an ever cheaper price. So those two are benefiting like there's no tomorrow. However, the other two pillars, the government and the labor market, they are being left out. And that somehow is not how the system can continue to work. The government, of course, will start kicking around and making sure that they get their fair share of tomorrow's society. Labor is missing out at the moment, and that's where this whole model all of a sudden starts screeching and may not necessarily be beneficial to all of us. Because while we have all the benefits as a consumer, if there's no benefits on the wages side, how long can we really be happy if we have all the benefits as a consumer? And that is the question I asked myself a few years ago, and I've been a very keen observer of further developments since. One of the developments, of course, is this particular guy. And if you have a little bit of knowledge of the music, then you know where the title comes from. But I mean, I'm not going to talk about Donald Trump for too long. You hate him or you love him. It doesn't really matter. He's there, and he is there because of the diagram I just showed you. I mean, this is labor at the very bottom, basically saying to the system, we don't take it anymore. This is BS. We want a change in the system, and that's why we vote in someone like this. Anti-establishment, anti-system, anti-elite. He's far from the only one. We obviously have in Europe now, in the Czech Republic, for example, in France, in the Philippines, we have many countries where we get anti-establishment politicians moving into their job. Next year, we may see some more of the ugly side of this political populism. So far, we have been left insulated, and this will remain. I believe that we have yet to see the ugly side of this, and I mean, unpredictable when exactly that's going to happen, but it might. And then, of course, not many people would instinctively have made this connection, but everything I just told you also feeds in now into the financial markets. Bitcoin is very much anti-establishment, anti-system, anti-elite. Although that's of course how it started, and now it has actually been picked up quite quickly by the financial sector. And I couldn't help but noticing that FP Markets is now allowing people to trade in Bitcoin. Well, I particularly picked this particular chart because it says Goldman Sachs on top. Now, we all know that Goldman Sachs is one of the preeminent representatives of the high finance on Wall Street. The fact that they are, of course, are trading Bitcoin is a sign in itself. Let me put it that way. I'm not going to make any predictions about Bitcoin, because to be honest, I know my limitations as a forecaster, and every forecast I'm going to do is going to be wrong from the moment I close my mouth. Needless to say that I remain a keen observer of Bitcoin, and I have little doubt that in 10 years time we can all look back and we're gonna go like, whoa, was that a special time or what? But it comes from the same feeding ground. That's all I want to say. Now, moving back to the share market, here is another view on another observation, so to speak, why my three baskets approach can be useful to many of you in how you see Australian shares moving forward. On my observation, the basket number one, which is the stocks that used to be owned by just about everyone, and for good reasons, because they were very good for shareholders. But that basket now is being challenged by competition, by regulators, by overseas companies, by new technologies, by new business models, you name it. And as a result, on my observation, there's grosso modo, roughly taken, there's two outcomes, what we've seen over the past 5 years. And I believe that the past 5 years, to a large extent, will give us the blueprint for the years ahead as well. This is not something that's going to change overnight. There's a category of stocks which are high quality, who have a good grip on their market share and on their customers. But nevertheless, they are still being challenged. And because of what they are and the position they have and the management and etc., they move sideways. And of course, the share price moves every day, every week, every month. But if you take a little bit of a longer term view, and the prime example of this is Wesfarmers. Right? If you take a 5-year view of a Wesfarmers chart, and this is 1 year, by the way, but it doesn't change if you take a 5-year view, then you can clearly see, or you should be able to clearly see, that the share price moves between the mid-40s on the upside and the high 30s on the downside. Now, is that a good thing or a bad thing? Well, if you're a shareholder and you definitely do not want to say goodbye to your shares because for whatever reasons, well, then my view is, or my advice would be, have low expectations. I mean, they pay a good dividend. The share price, in my view, is going to remain in that range for a long time to come. So you want to buy some new shares, buy them at the bottom of the range. You want to offload some shares, offload them at the high end of the range. As a trader, of course, you could integrate the same strategies the same approach in your strategies, which is basically what I was trying to say. Now, Wesfarmers is not the only one. I mean, you could make a point that the banks are also carving out a long-term sideways channel, and no doubt, if you start looking at more stocks, you will find that there's probably more stocks that are in the process of doing so. But there's also another scenario, and the other scenario is this one. There are stocks that are in a relentless, continuous downtrend. And I mentioned FlexiCorp earlier, though I mean Telstra would be one. And of course, here is why this is important. The share market and many participants in the share market, they have this reflex that if a share price drops, that it must be a bargain now. Well, that is not necessarily the case if a stock is in a long-term downtrend. Here's another example. This week, I couldn't help but noticing that Retail Food Group got clobbered, absolutely clobbered. And that happened after the share price already has been on a relentless downtrend. Now, the experience of BHP between 2012 and early 2016 had taught me already that buying cheap stocks when they are on a long-term downtrend is not going to do you any good, because apart from the occasional rally that always happens, because I mean, plenty of people around who think that they are on a bargain, the share price will ultimately end up lower. This chart in particular is from BHP, It's from my book from 3 years ago. Look how I sort of like point out whenever people go like, buy it because it's cheap. At the time, the share price was $22 something. I predicted in the book that the share price would end up lower. I was right. It almost halved from that point again. Now, of course, it's back. $27. If you look at this chart, $27 is nothing. I mean, this chart shows you that the share price used to trade in the 40s, if not in the high 30s. $27 doesn't even get close to that. Now, and this is a company that at the very least, after getting clobbered again, had the advantage of a recovering commodity space. Stocks like Flexi Group, like Retail Food Group, and others in a long-term downtrend, they do not have, Oraton, for example, they do not have the support of a recovery in commodity stocks. So be careful in buying cheap. Pay attention to the fact why. What is happening? Is this a long-term downtrend or not? Admittedly, it's always easier to establish in hindsight, but it does help when you have a broader view while those things are happening. Now, on the mining side, there is, as not always, but at this point in time, there's definitely a divergence in views. I think it's probably only fair to say that most analysts are surprised by how high commodity prices have gone up and for how long they've stayed there. For those who don't necessarily know what FN Arena does, the company I've founded, we keep a close track on analyst expectations and forecasts in the share market. So we sort of see what's happening in terms of when they all increase their forecasts or decrease them. And in recent times, they are catching up in terms of profit forecasts for commodity companies, but you have to be a tremendous bull, and not everyone is that on the commodity sector. The reason why I brought up this particular chart, because I think this is very interesting. This is from the Lion Fund in the Australian share market, and those are guys who are specialized in investing in commodity stocks. And what this mining clock, basically suggests is that we are now moving into a phase that becomes tougher to make money from the commodity space in general. We've had the easy returns. We're now moving into a space that in the foreseeable future it is going to get to the sell signal. Now, that is one approach. Another approach, also by guys who are completely into commodities, is this one. And this one shows you the difference between commodities and equities. And on this chart, commodities on a relative basis have seldom been as cheap as they are today. Now, here, the obvious conclusion, of course, is stack up on commodities because they are going to outperform from here. I can see the rationale for both, and I would be, to be honest, I would be more verging towards the first view of the mining clock than to this one, because I actually believe with all the new technology and the innovations that in the 20s, where we will probably get through a long-term period when equities will outperform commodities. But my view at this point in time, and this is something I've been telling people in recent months anyway, is I don't think the story of commodities is global synchronized growth. Forget about that one. That's not it. The stories about commodities is now twofold. It's either policy changes in China, or it is innovation and technology and then linked to commodities. And the second part, we've obviously seen in recent months where everyone gets crazy when it's about cobalt or lithium or graphite, because we're all getting crazy about that new battery technology that is supposedly ready to conquer the world. The first part, the China part, is not something that I believe has caught on yet in the Australian share market, but it is happening. And China is going green. And in a wicked way, that is reforming commodity markets and is actually creating a two-tiered commodity space where the high quality product gets a premium price and the low quality product gets discounted. And the clearest way to see that is to look at the iron ore markets, where the likes of Vale, BHP, and Rio are enjoying like almost unseen premium for their prices, and the likes of Atlas Iron or Mount Gibson, um, Mineral Resources, Fortescue, they get a much lower pricing. It is possible that this now will become a more permanent feature of the iron ore market, and that obviously will have consequences for those stocks involved. One of the reasons why I, for example, haven't gone anywhere near Fortescue despite the share price fall. And you now understand why that is. Um, the third element which should be on everyone's radar is that because the commodity companies are now being fiscally responsible, let's call it that way, they will give a lot of their cash flow back to shareholders, and that is one way that will support those share prices and will give rewards to shareholders. So those are predominantly the big ones, but it will also include likes of Whitehaven Coal and South32, I believe, and quite some gold producers as well, by the way. So that's a few handles to direct your personal research in these matters. This is we've changed to a different chart now, and this is one that depicts the re-rating of the healthcare sector in Australia. And remember how I told you that on a risk-adjusted perspective, basket number 2 is the lowest risk and the highest certainty. And that has now created a sector that is both on a relative basis to the rest of the share market and on a relative basis to its own history is now priced quite expensively. Well, if you call it like that. And the reason for that is that healthcare stocks are solid, they're robust, they have good management, they have a long-term uptrend under their wings, and they seldom issue a profit warning. I said healthcare stocks, but of course, the ones I have in mind are CSL, Ramsay Healthcare, Cochlear, ResMed, and a few other ones. The key challenge here is to avoid the ones that are not in that category, even though they have a label of healthcare on them. And obviously, the obvious ones would be the likes of Healthscope, for example. Again, it's not because a stock is cheaper that it's actually better. What you will find is that quality deserves a premium, and that translates into a higher PE. And because a lot of people don't understand this, they always end up buying the wrong stock. And it goes like this. You get a choice between Ramsay Healthcare and Healthscope. Which one do you choose? Usually, the answer that comes back is, well, which one's the cheaper one? And then the advisor says, well, Healthscope is the cheaper one. Well, there it is. Wrong answer. It's not only with the healthcare stocks. I mean, I see it happening all the time. You get the choice between Aristocrat Leisure and Ainsworth Gaming. Well, which one's cheaper? Wrong choice again. People underestimate the quality that is present in the Australian share market, but also how that quality translates into a higher premium valuation. So they make the wrong choices purely based on which one is cheaper. Now, as if that wasn't controversial enough, a little explanation in how PE ratios actually work, and because most Australians, they have a good understanding about how housing works because we're all fascinated by it. Most of them are. So I'm not gonna make this very long, guys, but just as a little thing to think about. show this to anyone, and of course, the house on the top end is of course the most beautiful one, the most expensive one. It's a delight to live in. At the bottom, you have two houses that really need a lot of work done. So it's very logical that the price we will have to pay to own the top one is going to be much higher than the ones at the bottom. Now, in housing, everyone understands this also because you can see it right in front of your eyes, right? It's a much better premise than the other two. Now, in the share market, they all just have a name and a company name attached to it, and they all have a management team that will tell you that they are the better one. Now, this is exactly how the share market also works. The premise on the top would have a PE between 20 and 40. The one at the lower end are between 1 and 10. I mean, it doesn't mean that when the top one is rated at 22 times next year's profits that it's expensive. It also doesn't mean that when one of the bottom ones is trading on 8 times next year's profits that they are cheap. If you understand this principle, you will understand more about the share market than just about 86% of all the commentators and advisors you will encounter in Australia. And I just made that number up, but not the principle behind it, by the way. Anyway, we'll stop being controversial now. We'll go back to what I said to you earlier. This is a time when small caps are trading at a premium to large caps. And I mean, you can sort of make that point that's maybe dangerous in the short term, because what the share market always tries to do is go for the cheaper options, and you just can't help it, even though it's only a short-term thing. Because if you go back on this chart, look a little bit further, you'll see that leading into the 2008 bear market, small caps were on a premium for like 3-4 years. That's how long that premium period can go on for. Now, we always have to keep in mind when we look at those charts, the composition. And the reason why small caps in that period, of course, were at a premium for such a long time is we had a raging bull market in commodities. So all those small mining services providers and mining companies that were in there too, and they are less at a premium today. But I still believe that beyond the short term, that in the 20s, in the decade that is about to come, that we will probably have a prolonged time of premium for small cap stocks. And essentially, I've given you the reasons already. I mean, it's because a lot of these large cap stocks in Australia are in basket number 1, and a large part of the smaller cap stocks are in basket number 2 and 3 in the Australian share market. And that, I think, should sort of explain it quite succinctly. I like to point out where the masters are wrong, including a lot of the commentators and analysts in Australian share market and journalists as well. Everyone is like focused on Amazon, and that's why officially bricks and mortar retail share prices have come under pressure, and that's why they rallied recently, because the introduction of the Australian platform by Amazon wasn't that spectacular. I've taken a different view, and have held a different view for at least 2-3 years now. I am worried about consumer spending in Australia and about the outlook for consumer spending, and I've had that for a while. And here's my thinking. The average household in Australia has too much debt. We are getting squeezed, and because I'm also part of an Australian household, we are getting squeezed on the side by school fees, by utility bills, etc., petrol prices now again, and we are not seeing anything happening in terms of wages growth. Now, that is not a cocktail for a splendid outlook for the Australian economy, in my view. And what we've seen so far is that while indicators for business conditions and business intentions are quite good, it's not good for as far as it relates to consumer spending. Now, what we all have to understand is that every developed economy, including Australia, is more than half consumer spending. Not retail spending, but consumer spending. Retail spending is part of consumer spending. And this is why I've steered clear from companies that were basically being categorized as retailers. So I'm not in super retail, I'm not in JB Hi-Fi, I'm not in Harvey Norman, I'm definitely not in Oroton or Retail Food Corp or whatever, because I believe that sector is going really through a tough transition, and we've only just begun. I think there's much tougher circumstances ahead of us. And in that case, remember what I said earlier about the long-term downtrend, and that means that share prices can get a lot cheaper, or they can stay cheap for quite a while. And remember, I'm the type of guy who likes to invest in stocks, invest, not trade. I like to invest in stocks that have an upside to them, and not just because of the share price, not just because it has fallen. Now, why is this one interesting? I saw this one, and it was actually being constructed by analysts at Credit Suisse. And they have, as sometimes as they do, because they have all the time and expertise for it, they've developed their own indicator, which in this case, which measures the gross domestic income of Australian households. And basically what you see here, it started falling off a cliff from the midst of this year. And we've seen that. We've seen that in data that has been published since. We've seen that in share prices of retailers, and we've seen that in retail experiences. And the other thing, now that we mention it, this is the next chart, which I'm showing now, is the official retail sales growth as published in Australia. And you can clearly see that since 2014, it is trending downwards, and it's trending downwards very pronounced, in a very pronounced way. The average retail sales growth today would be regarded as a low point in previous eras. Now, I am afraid that this is becoming more the norm. For bricks and mortar retailers, this means they will have to adjust dramatically. They'll have to reduce their cost levels and probably have to swallow quite some lower margins. And again, take this all together, and you can easily see why I am not going there as an investor. For me, it's too difficult, because I want to remain certain that whatever goes up today doesn't come down tomorrow. Now, I'm going to take a sidestep here, because this is one of the other things that the share market gets pretty hooked up about. It's all because listen, we probably have seen the low in interest rates globally. We probably have seen the low in bond yields, but it doesn't mean that we have mayhem around the corner. What it probably will mean, and I'm a big proponent of the lower for longer, and that includes inflation, by the way. Many reasons why inflation is not spiking higher, and I have to give it to Janet Yellen that she actually came out and said, even though she's an expert in the U.S. labor market, that she actually can't explain. She actually has no idea why it hasn't spiked up higher, but it hasn't. And one of the characteristics of a low interest rate environment is that it creates barriers to move higher. And personally, if predictions as done by some economists prove to be accurate, and I have serious doubt, to be honest, but let's assume they are proven accurate, and we will have fast interest rate hikes from mid next year, both in the US and in Australia, I would get really worried, guys, because there is so much debt out there, and there's no way that everyone is well prepared for higher yields. But in general terms, we've just had a period of very low, extreme low volatility, and an onward and upward trending US equities market. I sort of have a suspicion that as we move towards less accommodation from central bankers and towards tightening in some of them, that we will get a lot more volatility, because it's going to spook and it's going to make a lot of people very, very worried. I don't think we're about to see Armageddon for this particular reason, but I do think that it's probably likely to expect a lot more volatility in 2018. Here's something else I want to share. I already sort of earlier made a comment about how a falling share price or a cheap looking stock doesn't necessarily mean it's good value. It's probably one of the most difficult things to explain to people who start using FN Arena data, is that when a stock is, let's say, 50, 60, 70, 80% undervalued, and then they don't understand why it's not a good buy. That when you have such a severe undervaluation, that's the share market essentially showing you or telling you there's a lot of risk involved here, right? I don't know what the latest number was before Oraton called in the administrators, but I have a suspicion it was that high. The same thing, what a lot of people don't realize, is the same thing can be said about yields, dividend yields, implied dividend yields. And I built this little yield risk-o-meter, if you want to call it like this, and this is how the share market talks to you. And I always said the share market is a woman, and most people who trade and invest in the share market are men, so they don't understand what the market is telling them. But in general terms, you can tell from the yield that is implied, forward-looking, forget about franking, share market doesn't think in franking terms. The share market communicates in rough terms to you what is the risk with the yield stocks you're looking at. Right? And for example, right, if you're in the 7% and beyond, that is the high risk sector. Most people think like, oh, that's a juicy yield, it's a good buy. No, it's not. It can be if the market prices it at a higher risk than it actually deserves to be. But think back, before Telstra had to cut their dividend, what was the implied yield? It was more than 7%. That's where the share market is telling you it's probably not sustainable. Now I know that Telstra in recent times has rallied, but as far as I'm concerned, that's just the market trying to rotate when the share market can't go anywhere. Anyway, I wouldn't draw too many conclusions from those short-term share price movements if I were you. But it just shows you that anything can rally as long as it starts from a low point. Use this yield risk command to your benefit, I would say. And obviously, needless to say, as a long-term investor myself, the preferred stocks I buy is around that 4%, because you get your 4% yield plus you get a lot of growth, and you end up your total return is the way how you should look at your returns. My total return tends to outperform a lot of other stocks and a lot of indices as well. Now, here's my explanation for what happened to the share market this year. From the moment I saw this chart, I accurately predicted what was going to happen, and it has happened so far. This chart, forget about all these little whatever, it's on there, just focus on that blue line that goes from left to right and then spikes all the way up from late 16 throughout 17. That is what super funds have in cash. And you can tell this one goes back to all the way 2003, and it has never been this high and never even been close to this high. So in my view, in my interpretation of this chart, what has happened is that because there were so many reasons to be cautious from late 2016 onwards, throughout 2017, it was always something. If it wasn't Trump, then it was Korea or something else. And they all kept their cash on the sidelines. And then, of course, they thought, you know what? We're just going to wait until the September weakness kicks in, and we're going to put some money in the share market. However, and this is also a good reminder for those people who constantly concentrate on the traditional seasonal patterns. I mean, they do not always happen. And because everyone was waiting for September weakness, it did not happen this year. And then the calendar says October, and all those managers become very, very nervous because all of a sudden, psychologically, they think, but the end of the year is near and I have so much cash. So what has happened? And you can check this, by the way, from the moment the calendar went into 1st of October, cash started flowing into the market in big terms, and it was a big rally for the month. We've seldom seen an October as strong as it was. November was still strong, and then we moved in December. A lot of that cash has now been put to work, and now the share market doesn't know what to do. And we've seen that in the past few days. It's almost literally that the Australian share market locally doesn't know what to do. And I mean, so it does nothing, just rotates a little bit around. Looking forward, and this is obviously what a lot of people want to know, but what's going to happen with this share market? Well, there's many ways to look at the share market from a broader perspective. This is one I always keep a close check on, and this is the concept of the share market. You have 5 stages, well, 4 in the bull market, 1 is the bear market. And if you follow this concept, then now we are in the final phase of this bull market. Now, that is a view that is, by the way, I find back quite on a regular basis by strategists and analysts, in particular in the US. Now, that doesn't necessarily mean it's bad news, because if you look at this one, and this one groups together the returns in each phase, then you will find that obviously the recovery phase from the bear market, that's obviously when you make the most returns. And we all know that. I mean, 2009, 2010, the V-shaped recovery, that's when you make a lot of money. But out of all the other phases, the final phase is the other stage when you make most of your money. And this is the reason why professional managers will be keen to squeeze out everything they can from this final phase in the bull market. And some strategists I know that they hope they can get like another 20% or something over in this final phase, where they think it's going to be a blow off top or something along those lines. Now, in theory, of course, this all sounds very good and very logical, and in practice, often we can only define these concepts and these exact timings in hindsight, of course, and otherwise, I mean, if it's that easy, everyone would do it. But the good news, well, the bad news is that this might well be the final phase of the bull market, and it has been a long bull market, in particular in the United States. It has been a weird one. My view is that this is an American bull market, and Australia gets dragged along, and so Australia at times doesn't know what to do. The good news is that there are usually very, very good returns to be made in the final phase of the bull market. I'm not going to talk too much about this one, but this is what I specialize in the share market. In general terms, the black line you see swirling around, and those are the usual stocks which I'm predicting that most of you guys will be interested in. I mean, they swirl around and they get sold down and then move up again. I'm more interested in the red line. And the red line are what I call all-weather stocks. Stocks that trade on a high PE. They also achieve high growth. They have a very high reliability towards their shareholders, and they perform year in, year out. What you see there is not stocks moving sideways, but it actually shows you there's not much variability in the PE ratio and the share price. So it means they seldom generally sell off, and if they do, they don't stay there for a long time. Go back in your memory and remember when CSL temporarily fell to $92, it stayed there for all of 2 seconds and then moved to 125. A reminder to everyone, and I'm not going to spend too much time on this, but this is, I would hope, clear to everyone. This is the reason why making predictions about the share market is so difficult. I mean, apart from earnings growth, we should always remember that while synchronized global growth, which we are experiencing now, makes everyone very happy and makes us all very optimistic, it doesn't do anything to the share market. I mean, there is historically no reliable correlation whatsoever. Think about if you go back a few years, the US economy looked really, really shaky, low growth, was not much happening, yet the share market still went through a bull market. Because in the end of the day, we're not investing in the economy, we are investing in companies. So earnings growth by companies is always key. And at the moment, expectations for next year are really, really high in the US, not in Australia. The second element, of course, is what happens with inflation, bond yields, and interest rates. Now, they are going to move up next year. I don't think in a hurry, but they are moving up nevertheless. It's going to put a little bit of lid on risk assets. It's going to dent optimism and enthusiasm at times. But the most unpredictable factor here is sentiment, and sentiment really is important. And the more I follow the share market myself, the less I start predicting about where the share market goes, because I don't know how at the moment sentiment is really, really good in the US. Although I pay close attention because I can see how vulnerable and fragile it actually is in Australia. Because Australia, in many, many occasions, doesn't really know what to do. That's because it's not an Australian bull market. And why isn't that? Well, maybe this little table gives us a little bit insights on this. I always say to people when they ask me, why is your Australian share market not performing anywhere near like the US? And I know some economists will tell you it's because we didn't have a recession and we outperformed pre-2007 and all that. But at the end of the day, as I said earlier, it's all about corporate profits. And corporate profits in Australia have been dismal. They have been absolutely dismal. And in some of the years when they were good, for example, they were fantastic in the year leading up to June 2017, this year. That was because the resources industry, the resources sector, they absolutely killed it on that strong rally in resources prices. But look beyond the resources recovery, and we are again reverting back to a low growth market. And low growth and high yield is what we have to offer. This is also a reason, by the way, why those companies who do have high growth, they will trade on a premium valuation. And it's again another reason why a CSL on a PE higher than many other industrial stocks is not necessarily a bad buy still. Now, I'm going to share with you one more chart. Well, it's not even a chart. It's two paragraphs from my book at the time. And while I can do this for hours, but I'm assuming at some stage we all get a little bit tired of this, including myself. But I sometimes share this one with people because 3 years ago this was my prediction. Because of all the changes that would come towards the Australian economy and the Australian share market, is that making accurate investment approaches and strategies for the longer run would become a lot more tricky and a lot more difficult to do. And I do think, and I hope you all agree with me, that whatever happened over the past 5 years has proven exactly that. And I think that it's not going to change over the next few years. It doesn't mean that there's no good returns to be made. It just means that we have to look forward and have to start looking less over our shoulder into what used to work. And I'm hoping, of course, that my three baskets approach could help me by doing it. And I think with those words, I would be open for questions. I hope you liked it, guys. And I do manage my own portfolio, which is concentrated around those all-weather stocks. We did launch a new website this year with FNArena, and we're very proud of it. I think we've built one of the better ones in the market. Do check it out. And whatever you do, I think this is a very good typification of what happens in financial markets. So remain level-headed, although I know it's not always easy to do. I am going to have a look now in some of the questions I have here. And I'm because I'm new to this, I haven't really figured out how the questions side works, but there's someone to help me here. Oh yes, here's one. I'm just going to go through a few questions which I won't spend too much time on, but so that means I can hopefully get through a few of them. Someone asks me, in what basket would you place Blackmores? Is it health, retail, or consumer? Well, it's definitely consumer, but obviously there's a health effect to it as well. I actually think the Blackmores is in the second basket, which means it's not so much impacted by innovation and by regulation and all that. The only thing I would say with regard to Blackmores is that if you go back in the past, there has been a time when Blackmores had a bad year or a bad 18 months or so, and that was because Swiss was forcing it to spend a lot on marketing, and that's the element. If you are interested in Blackmores, that's the element you should pay attention to, whether Swiss is causing trouble essentially, and that makes Blackmores vulnerable because at the end of the day, Blackmores is a relatively small company. I have a question here that says, how do we know that the market price will be increased in the next 10 years? We don't. I just spoke to you about the lost decade in Australia. The right way to look at the share market, by the way, is you should actually correct it for inflation. You know that inflation often gets translated into share prices, but usually that's why share prices end higher after 10 years, because you've had inflation over those 10 years. But in general terms, and this again been proven, if you have a low inflation environment, it becomes more difficult for companies to sustainably increase their share price, in particular when they're challenged. A question about gold. How do you think gold will fare in 2018? I'm not a big fan of gold. And why is that? It's because I know that rising yields on US treasuries is the single most important denominator for gold. If you think that yields will go higher in the US and hopefully that doesn't translate in too strong a US dollar, then gold's not going anywhere. And I know people get excited when it gets past 1300 US. I actually don't, because I look at the 3-year price chart of gold, for example, and in my view, it's going sideways. Now, gold can, at some stage, start playing a more important role, but we need to see more geopolitical uncertainty. I mean, maybe if North Korea starts causing mayhem, or if the share market sells off because we get the bad side of Trump, that's potentially when gold can come into play. But in general terms, in the context as it is, I can't get very excited about gold, and that's my personal view. I have one here about Invocare or FPH. FPH, a better investment for the next 5 years. I'm assuming Fisher & Paykel Healthcare. I would probably go for Fisher & Paykel Healthcare, but I wouldn't discount any of them, to be honest. I know people complain Invocare is too expensive. You know what? Just wait until the share price gets cheaper, which at some stage will happen. You don't chase them to the upside. You just wait until they conquer a little bit to the downside, is my view. And if you want to step in stocks like an Invocare and a Cochlear, for example, don't chase them. I mean, the share market has its strange ways of every once in a while pushing those share prices lower for temporarily, and then you just be a patient hunter. You just shoot and make sure that you don't miss and that you only have a few bullets. That's how you should operate in the share market, in my view. I don't even understand these questions. I'm gonna skip this one. Then I have a question about what I think about Bitcoins. Well, here is my problem with Bitcoins. I can't place a valuation on it. And while it's very interesting, I have no idea what it's going to do tomorrow. So it's not the right question to ask me, to be honest. But I am a keen observer, just like many other people. I guess it's a little bit like what people sometimes say about picking up dimes in front of a big train. I mean, you don't want to be overrun by the train, but maybe you don't want to leave the money on the road either. A2 Milk, question about A2 Milk. I think A2 Milk is in the second category. It's high growth. It benefits from all the changes in the world. It's a very good marketing machine. It already has proven that in that category, it's one of the better operators. It's high quality. It has immense leverage and growth in that business model. It probably will, even from today's levels, probably will perform really well in the years ahead. Probably another stock that you don't want to chase up, but you want to shoot when it temporarily gets down. It's amazing how companies like an A2 Milk are able to translate their qualities in high sustainable growth. And again, I mean, we have other companies in that sector, and they've all gone through a much more difficult period, and A2 Milk hasn't. And it's very simple, guys. This is how management in that company proves how good they are and how well they run the company. And I have one last question about Sirtex, and I would say, I was about to use a swear word, but I probably shouldn't be doing that. Listen, I'm not a fan of Sirtex at all. I think Sirtex is one of those examples where the circumstances have changed. They have, to date, they've done really their best in building that business out and in enforcing their proposition with trials. None of those trials has worked out. In the meantime, there is competition in the US that is gradually putting all the pressure on Sirtex, offering better products, taking market share. I think Sirtex is pretty much under pressure and should definitely be in basket number one. And I haven't looked at the share price chart for a while, but I wouldn't be surprised if any 5-year-old would tell me that's a downtrend, and that means it's looking not very good for Sirtex. Well, what can I say? Thank you all for your times, guys. I hope you enjoyed it as much as I did. If you now all tell the people from FP Markets that I did a good job, then maybe I'm allowed to come back next year. Otherwise, I'm just going to hand over to one of those guys from FP Markets, and I'm going to wish you all a happy Christmas and a happy New Year, and maybe see you back in 2018. Have fun, guys.
Well, thanks for that, Rudy. Really interesting stuff. I'm sure we can get you back on in the future. I mean, I particularly enjoyed your analysis on the market cycles and view on the emerging technologies on different sectors. And I'm sure everybody else agrees that they got a lot out of tonight. Now, just to cap up, as we spoke about at the start, if you were looking to become a member of FN Arena, we are doing a free 3-month subscription with all new openings of accounts. Just on top of this, with our new MT4 customers, so that's where we're trading Bitcoin at the moment, you'll receive a 20% trading bonus up to 2,000 Australian dollars on your initial investment. And for your direct market access CFD trading, so looking at those equities, we will be offering no minimum ticket for the first 3 months on the ASX. So, if you're looking to purchase $1,000 worth of shares, it's only going to cost you $1 in commission. Now, the link to applying the terms and conditions can be found in the chat, but will also be included in a follow-up email from your attendants. You may also email the sales team via sales@fpmarkets.com.au if you have any questions about the promotion or the webinar. We can always send those through to Rudy, and hopefully he'll get back to us. And just with that, the offer is valid until the 1st of the 1st, 2018, so to the new year. Thank you all for joining in tonight, and hope to see you again at the next webinar. Thank you.